and we're actually at the threshold. My recommendation has been at 50 to 1, you figure out how much gold you want versus silver. And let's say that you decide on an 80-20 mix. Figure out how much that is in relation to your position, and swap a quarter at 50 to 1. Swap another quarter at 40 to 1, another quarter at 30 to 1, and then the last one, just follow your gut.
They know gold better than anyone, although they're not in that market anymore. Next stop for gold, they say 6,600. You got Jamie Dimon talking about it. You have Goldman Sachs talking. Everyone's talking about it at the ultra high level.
Markets usually break long before headlines admit it. The first signs are not crashes, but contradictions. When official prices no longer match real transactions, when contracts settle in cash instead of goods, and when analysts are forced to abandon positions they once defended with certainty. That tension is now visible in gold and, more acutely, in silver. Despite a temporarily stronger dollar pressuring gold headlines, institutional demand continues to build beneath the surface. Silver, meanwhile, has moved aggressively enough to invalidate repeated bearish calls, exposing a widening gap between financial theory and physical reality. Bill Holter, a market veteran with 23 years of Wall Street experience as a retail stockbroker, argues that what is unfolding is not a speculative spike but a systemic failure. He points to the gold-silver ratio as a strategic tool rather than a trading gimmick. His recommendation has been to gradually exchange silver for gold as the ratio compresses, scaling swaps at levels such as 50 to 1, 40 to 1, and 30 to 1. In his view, this approach increases long-term gold ounces without relying on perfect timing. More importantly, Holter contends that silver's sharp rise over recent months signals that long-standing price suppression is breaking down. Central to Holter's thesis is the distinction between paper and physical markets. He emphasizes that COMEX functions primarily as a paper exchange, while cash-and-carry markets globally are increasingly trading silver at premiums. He cites examples where silver prices in China have closed materially above U.S. levels. For Holter, the answer is clear: the market demanding physical delivery. He warns that a failure to deliver silver, potentially as early as the March-April window, could trigger force majeure settlements in cash. Such an outcome, he argues, would expose futures contracts as effectively worthless if they cannot perform. If you're finding this analysis helpful, don't forget to like this video, subscribe to my channel, and hit the bell icon so you never miss updates.
The action in silver over the last 3-4 months, the move, up to hit 50 through 60, 70, 80, 90, that move shows that the suppression scheme is failing. And the reason it's failing is because COMEX is primarily a paper market, yet the cash markets around the world are all trading much higher than COMEX. So you've got to ask yourself, what's the real price? Is the real price determined by paper contracts, or is the real price determined on exchanges that are cash and carry? I mean, COMEX last night in China silver in China closed at 91.50. That's $10 over U.S. prices. So what's the price? Is it 101 or is it 91? It's clear that the paper scheme is failing. Yeah, for those that think gold and silver are not important, I would just say, just watch. You're going to find out. In my opinion, silver will fail to deliver, probably in the March, April timeframe. When I say fail to deliver, I think they're going to go force majeure, and they will deliver cash instead of silver. And what that tells you is that the contracts are worthless because if you can't perform. And my past partner, Jim Sinclair, used to always ask the question, what is a contract worth if it cannot perform? And the answer to that is zero. People need to understand that when silver fails to deliver, that is going to set off the derivatives complex, the what Warren Buffett calls weapons of mass financial destruction. They're going to blow up because confidence, trust is going to break. As soon as silver goes failure to deliver, gold will follow. And when you have contracts that are not performing, then you're going to have traders asking, well, what's next? Is wheat next? Is nickel? Is copper? Is oil? You name it. And understand that the derivatives complex is probably at least 4 times the size of all the assets on planet Earth. So it's truly the tail wagging the dog. Everything was financialized, and that whole thing is going to unwind. And when we can talk about the unwinding, if you want, regarding the Japanese carry trade. That's unwinding before our eyes. At what has happened throughout history, whenever a government monetizes, their currency blows up. The problem with the dollar blowing up is that it's the world's reserve currency. Central banks all over the world hold U.S. treasuries on their books, and that has been a core asset. Um, the fact that foreign central banks and treasuries are turning away from U.S. treasuries and buying gold tells you they see an event coming with the U.S. Treasury market, some type of credit crisis, and they're unloading gold because they want that to offset the losses that they see that they're going to take in the Treasury side. Gold and silver would reset to higher numbers and not come back down like they did in 1980 and 2011. Uh, one of the things he used to say, and I believe it's correct now today, that this is the rally you don't sell. This is the rally you don't try to trade. The reason being, we're going to wake up one day and, like you just talked about, there's not going to be any metal available to buy. So if you had sold and taken a profit, where are you? You're sitting in Federal Reserve notes without the ability to get back into silver or gold. So this is the rally you don't sell. As far as positioning of gold and silver, I mean, I've recommended now for probably 10 years, because of the gold to silver ratio, that people be at least 70% silver and only 30% gold. And I told people I don't have a problem if you go 100% silver, because the idea is when the ratio comes down, then you swap some silver for gold and you'll end up with more gold ounces than if you just bought them outright.
Andy Schectman, CEO of Miles Franklin, approaches the issue from the vantage point of physical flows and institutional behavior. Drawing on decades of experience in bullion distribution, Schectman highlights delivery data that would once have been unthinkable. Tens of thousands of gold contracts standing for delivery on COMEX each month represent a structural shift in behavior. Historically, less than 1% of contracts ever resulted in delivery. Today, sovereign entities, central banks, and large institutions appear to be removing metal from the system at scale, often without public commentary. Schectman also stresses how underallocated gold and silver remain in global portfolios. He references industry figures showing that average allocations to gold-related assets remain below 0.5%, even among sophisticated investors. Recent purchases by major endowments and changes in recommended portfolio structures by senior strategists at global banks suggest early recognition of risk, not mass participation. From his perspective, the public has not yet awakened to the challenge of preserving wealth in an environment where financial assets are heavily leveraged and confidence-dependent. Schectman discusses mining ratios, long-term historical norms, and the growing tension between dwindling supply and rising industrial demand, while questioning the legality and sustainability of large concentrated short positions. Let's get back to the video.
A business over the last few months has been parabolically higher than it had been any time since the pandemic. As Rick Rule would say, always, again, using Rick's comments, which I've copied, I've been friends with him for 25 years, is that from the average allotment or allocation of gold and gold-related equities from Joe and Jane Sixpack to the Harvard Endowment Fund is less than 0.5%. Now, the interesting thing is that the Harvard Endowment Fund just spent, I don't know, between 1 and 200 million on gold recently. Things are changing, but it's at that level that we're seeing the majority of purchases. During the silver squeeze, everyone and their sister and brother was calling us, and we were doing, 1,500 orders a day. Now it's a fraction of that, maybe 500, much bigger in scope. You have people who are scared that the realization that things not only are messed up politically, geopolitically, morally, socially, even take your pick, go down the line, but that the dollar's in trouble. We can't even agree to keep the government open through things that I'm not going to talk politics here. I have strong views on it, but it usually ends up being too polarizing. So we'll just simply say we're at a place where people who have worked all their lives to obtain money realize that it's easier to make it than it is to keep it. And so we've seen a big rush into metals lately, but that's still, look at what I said at the beginning, record allocation to the equity market by the public, record speculation through options and leverage through margin, all-time highs across the board. And at the same time, this month alone, we've already seen almost 59,000 gold contracts. Yeah, 59,000. So it's 58,639 as yesterday times 5,863,900 ounces of gold have already been delivered on COMEX this month. Every single month we're seeing this kind of volume. That's never happened before. No one ever stood for delivery, ever. Less than 1% of contracts always stood for delivery on COMEX my whole career. Never saw it here in the US. We've been net exporters of gold forever until November, when Trump won the election. We've become, if not the largest importer of gold in the world, all of a sudden. Who's doing it? Why is no one talking about it? Why are we seeing billions and billions and billions and billions and billions of gold and silver come into the COMEX? Some stays, some leaves in the COMEX. Could stay in there, can leave. I don't know who's taking it. Why aren't we hearing about it? Why is there no mention of this on the media? I talk about it every day, but at that level, it's the people far above you and I and everyone else in this room who are the ones that have been buying it. The institutional traders, the sovereign wealth funds, the central banks. But to see it happening at this level, where you get the chief investment officer of Morgan Stanley now saying, instead of it being a 60-40 split between stocks and bonds, as Wall Street has used for 50 years, that was a typical portfolio. And in an interest rate environment that's going straight down since 1982, that would have done well. 60 stock, 40 bond. Now he says, no, 60-20-20. Sell half your bonds, put half in gold. Michael Hartnett, the chief analyst for Bank of America, no, he says 25 stock, 25 bond, 25 short-term treasury, 25 gold. You got Jeffries, a former U.S. Mint authorized partner who I worked with for years, and they nominated us to be a authorized reseller. They were one of the primary distributors for all the mints. They know gold better than anyone, although they're not in that market anymore. Next stop for gold, they say 6,600. You got Jamie Dimon talking about it. You have Goldman Sachs talking. Everyone's talking about it at the ultra high level. Those people have been doing it, but the public, no, they're still anesthetized. But like I said, if it's 0.5% and it goes to 2%, well, that's a fourfold increase in demand. And guys like Keith would notice it. And it is getting busier. I notice it. But we're yet anywhere near, I think, that level where the public has woken up to the fact that the road to retirement is not always just paved with stocks and bonds and mutual funds. Quite to the contrary, we are entering a period of time where even the best laid plans need to be reevaluated. And this is not just in the United States. These are the kind of UK, France. Have all been in cahoots with this. Standard Chartered Bank, HSBC. These are all the banks that were told by, my belief, by their respective Western governments, step on the price of silver, don't let it go. We need silver inexpensive enough so we don't get crowded out of the trade. And it's not even about the price going high. It's about it's diminishing in nature. It's disappearing. Ask Keith Neumeyer. He'll tell you it's coming out of the ground at 7-1. He's told me that personally for years. 7-1, but it's priced at 88-1. It was priced at 16-1 for 5,000 years. So a company like BlackRock, who is the primary custodian along with JP Morgan of the world's largest silver trust, and there's an 81 million share short position, which in my opinion should be legal.
Taken together, their arguments rest less on short-term price fluctuations and more on the erosion of confidence, the fragility of trust, and the scale of leverage embedded in the modern financial system. Neither speaker claims precision on timing, but both suggest that the imbalances now visible are structural rather than cyclical. Central banks reducing exposure to U.S. Treasuries while steadily accumulating gold, unusually large and persistent physical delivery demands, and the repeated failure of institutional silver short positions all point to a market in the early stages of revaluation rather than speculative excess. Their perspective challenges conventional portfolio theory, particularly the assumption that precious metals function only as tactical hedges. If gold and silver are increasingly being repriced as monetary assets instead of industrial or defensive commodities, historical parallels to 1980 or 2011 may offer limited guidance. In that context, volatility may reflect transition rather than instability, signaling adjustment rather than excess. If physical delivery truly becomes the defining line between price discovery and paper settlement, how will global markets redefine value when confidence in contracts is tested? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.